Since time immemorial, individuals could invest only in real assets such as land or gold. This changed in medieval Italy, as financial markets evolved in both debt and equity forms. In 1171, in the city-state of Venice, the world's first bond market came to life. Today, more than 850 years later, we will unpack this key milestone in financial history. We'll start with its setting, Venice in the late medieval period. Venice was established as politically autonomous in the 8th century after Byzantine control. With a steady population growth in the Middle Ages, Venice became the largest and probably the richest city in northern Italy by the 1100s. How did they do it? According to historian Gonzales de Lara, the economic rise of Venice was based on the expansion of trade along the Mediterranean and beyond. The most profitable trade was in Oriental luxuries. This trade required large amounts of capital and involved high risks. A round trip from Venice to the east took 6 to 9 months, and overlapping sailing seasons precluded financing with retained earnings. Fitting costs included a large armed crew and sail in convoys with naval protection. The commercial risk was also high, as profits varied widely, depending on commodity pricing, logistics costs, and tariffs or bribes paid in customs. How did they pay for this? To raise the required capital and share risks, Venetian merchants used 2 types of funding: sea loans and commenda contracts. The sea loan was a debt instrument, a fixed payment loan with a twist. The investor took the risk of loss at sea and was allowed a higher rate of return. The commenda was an equity instrument, a contract whereby an investor assumed liability for any loss in proportion to his capital investment, but also shared the profits with the merchant. According to historian Gino Lusato, Venetian trade was enabled by a financial market through which Venetians of various ranks and professions invested in merchant operations. For example, as the Tommaso nobles invested 500 Venetian pounds, a woman named Soria entrusted £8 in commenda to a merchant unrelated to her family. About half of investors belonged to the ruling aristocracy, but over a third of investors were commoners. Note that the market for both sea loans and commenda contracts was private. None of these were marketable securities. The financing of the Venetian state, however, was different. Historian Luciano Pezzolo explains that Venice, like other city-states, was often challenged with unplanned expenses from wars. Simply raising new taxes took time and could be rejected by citizens. Another solution was to borrow from wealthy citizens. Gino Lusato explains that, in 1164, Venice granted for 11 years the income from the Rialto market to wealthy citizens who had lent 1150 silver marks. Venice, however, regarded debt as temporary, eliminated as soon as possible. In 1171, the world's first bond market was born in Venice. In order to pay for a fleet against the Byzantine emperor, the Venetian state imposed a loan to every citizen in proportion to his or her assets, paying in return an interest of 5%. Venice became history's first state to transform their floating debt into a long-term consolidated, transferable debt. Luciano Pezzolo explains the features of Venice's bonds, called Monti. First, irredeemable compulsory loans. Second, paying moderate interest rates. Third, bonds were heritable, transferable, and could be used as means of payment. Fourth, debt consolidated and managed by specific authority. Finally, tax revenues obliged to pay interest. Historian Ranald Mishi comments that, if a single event could be taken to represent the start of the global securities market we live with today, it would be Venice's 1171 forced loan. A secondary market for these bonds soon developed, as holders in need of money sold montes. Individual investors had now a new asset class available: a bond market. Pezzolo explains that Venetian montes could be sold and used as collateral. Both the principal and interest claims were tradable. A complex capital market emerged. But Venetian montes were not bearer bonds. Every trade had to be registered at the state agency. A written or verbal order allowed the officer to transfer a sum from one holder to another. But the cost of the operation was low. The cost for the broker, scribe and taxes did not exceed 0.5% in the early 1400s. Venetian montes were soon copied by its competitor city-states, Genoa and Florence. Historians Frasciani and Spinelli explain that in Florence, early lending to the state was also compulsory, and as in Venice, based on a wealth census. In 1343, Florentine state debt was consolidated at a 5% interest rate. But in Genoa the evolution was different. State debt went through a series of consolidations before being purchased by a new institution, San Giorgio, in 1407. This put under one roof all Genoan state debt into a single San Giorgio asset bearing a 7% interest rate. San Giorgio was first a creditors' association but also a bank. The Genoan innovation was twofold. First, it was not compulsory, and second, public debt was converted into San Giorgio shares. This is exactly the technique of engraftment that would be borrowed by the Bank of England centuries later. Per Frasciani and Spinelli, the state debt commitment mechanisms in Venice and Genoa were quite different. In Genoa, government spending had to match borrowing, primarily from San Giorgio. In Venice, the state set tax rates and forced borrowing to match government spending, including interest payment on debt. The state in Venice was the protagonist of the commitment device. In Genoa, the state relinquished this role to San Giorgio. Which city-state was perceived as a safer investment? San Giorgio was perceived to be more solid and of lower credit risk, as its debt yields were lower than the ones on Venetian debt. How about defaults? Whereas Venice did not renege on its debt, it delayed interest payments in 1379, 1463, and in 1480. Genoa, in contrast, never defaulted. The verified sources we learned from to produce this video are listed here, and we encourage our curious viewers to dig deeper for themselves. What do these sources tell us altogether? First, the world's first bond market emerged in Venice, then spread to other Italian city-states, and then on to Europe. Both Genoa and Venice shared republican institutions and the rule of law, which gave them legitimacy and credibility to issue large amounts of long-term and marketable debt. Second, the city-states of Genoa and Venice developed many of the features later found in financial markets that rose to dominance: the Netherlands, England, and the US. But in medieval times the center of the financial world was clearly in Italy. Third, sovereign states can and will default. Venice, the first state to default, was not alone. France, England, and Spain all defaulted in the 1500s. The US itself last defaulted its treasury bills in April 1979. The takeaway for today's individual investors is twofold. First, some government bonds are less risky than others. In the Middle Ages, would you have bought Venetian or Genoan bonds? Second, be careful with the false idea that countries cannot go broke. In the early 1980s, Citicorp CEO Walter Wriston infamously stated,
"Countries don't go out of business. Their assets always exceed their liabilities, which is the technical reason for bankruptcy."
Perhaps Mr. Wriston was not as familiar with financial history as you are, dear viewers. Latin American bonds defaulted in the 1980s, and Citicorp shareholders paid dearly for Mr. Wriston's naivete.
Thank you for watching. If you'd like to learn more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.